Our economy began its expansion in June 2009 when the Great Recession officially ended. The expansion is the longest on record.
When times get tough, the inclination is to slash budgets, and marketing is usually one of the first to go. But this is a mistake, as you'd be cutting off the very programs that generate demand at a time when your business needs it most.
The biggest risk when investing is not investing at all in fear of a recession.
Now the chances are that the Federal Reserve will not want to impose such extreme negative interest rates. So the second option they have is printing money. Quantitative easing. Exactly what they did in the years following 2008. Now the problem with quantitative easing is that as we print more money, your dollar loses value. This is an extreme risk for anybody, especially the middle and lower classes who own most of their assets in cash in a bank.
Welcome to the Inside Forbes Councils podcast. Each episode shares transformative insights and advice from members of Forbes Councils, a group of invitation-only communities for successful executives and entrepreneurs. Today's topic, how to prepare your business and personal wealth for recession. We'll hear from Forbes Councils members Roxana Maddahi of Steel Peak Wealth Management, Natalie Nathanson of Magnitude Consulting, Jeeyan Rostam-Abadi of Hawk Media, and Felix Hartmann of Hartmann Capital. First and foremost, we must point out that nothing in this episode should be construed as investing advice. The opinions expressed in this podcast are the participants and are current through the date of the broadcast. These views are subject to change at any time based on market or other current conditions, and no forecast can be guaranteed. It's been 10 years since the Great Recession, and while there have been some stock market scares along the way, whether due to sovereign debt concerns or Brexit, we have not had a recession since. Are we overdue for one? Is it inevitable? Can and should you prepare? After the Great Recession of 2008-09, it's hard to not have a fear of a similar scenario playing out again.
My first job out of college was actually at Lehman Brothers, which started just months before Lehman Brothers filed for bankruptcy and the 2008 recession was in full swing. I thought I was going to this awesome high-paying Wall Street job, and just a few months after I started, they're filing for the biggest bankruptcy in history. Everyone I worked with was losing their jobs and their retirement money, and these weren't even the high-paid trader types. I'm talking about people with small salaries working on operations roles that relied on each paycheck to send their kids to school. I learned a lot from that experience and have made studying the markets and recessions a big part of my life since then.
That's Roxana Maddahi, a financial advisor at Steel Peak Wealth Management in California.
It's possible that a recession is on the horizon, but it really shouldn't matter what I think or what anyone else thinks. Most everyone's wrong about this question over and over again. CEOs, Wall Street analysts, and economists have been predicting a recession for years. Just to give you a few examples, in December of 2015, JP Morgan put out a piece predicting a 76% chance of recession within 3 years. Here we are 4 years later, and the global markets have rallied 54% since that report came out. In January of 2016, Citigroup put out a report predicting a 65% chance of a recession. Global markets are up 23% since that report came out. Happened again with Deutsche Bank in September of 2017. Their CEO made an announcement that most asset classes in the Western world are potentially overbought, meaning that potential bubbles exist in certain markets. World markets have rallied 23% since that comment as well. These people are smart, and at the time, the indicators were there for a recession. But the economy and markets move in ways that we sometimes can't predict or prepare for.
But there are signs of a recession, right?
So the first kind of indicator I see is that our economy began its expansion in June 2009 when the Great Recession officially ended. The expansion is the longest on record.
That's Jeeyan Rostam-Abadi, Vice President of Marketing at Hawk Media, which is an outsourced CMO consultancy.
So oftentimes expansions end and recessions start because some sort of major shock, right? This could be a political crisis from an oil shock, but it could also be caused by collective loss of confidence because people will think that things won't be so hot so soon. So people decide to stop investing, hiring, and investing in their businesses and building them because they're worried that everyone else is going to stop doing the same things. So in today's case, you can actually imagine this collective loss of confidence. Some of it can be due to the president's trade wars and fears of further escalation, but also because of what's happening globally, such as with Brexit, the China slowdown, etc.
There are 3 red flags that is signaling the beginning of the end of this current bull market. The first is that the current bull market has been the longest bull run in American history. And as we all know, nothing lasts forever. It is never wise to bet on extremes, as at the end of the day, most trends always return to the mean.
That's Felix Hartmann, Managing Partner and Chief Investment Officer at Hartmann Capital and Hartmann Digital Asset Funds.
Secondly, we saw an inversion of the yield curves for the first time since 2007, right before the big economic recession of 2008. We saw an inverted yield curve of the 2 and 10-year treasuries. Now, this generally only occurs about 18 to 24 months before an economic recession or downturn. We saw this happen in 2007, we saw this happen in the 2000s, and we saw this happen in the 1980s. Every single time being foreshadowing of hard times to come. And the third and final red flag are interest cuts. Again, for the first time since 2007, we've seen interest rates being cut. Every single time over the last few recessions, we saw interest rates being cut in advance of the recession. Why is that, you might ask? As the Federal Reserve starts realizing that the economic growth is slowing, they are trying to spur this growth, to keep it going by reducing the interest rates. The reason this works is that businesses and individuals will be incentivized to keep investing and to keep spending, as their savings are not paying them as much as they used to. This, of course, is only a short-term solution, as interest rates can only be cut so much.
When a recession does hit, and most economists agree it will eventually, even if the timetable is wrong, consumer discretionary businesses are often the hardest hit.
I think the first thing is you can really just outsource to stay lean.
Jeeyan Rostam-Abadi of Hawk Media again.
So one of the things I've seen as an example is that a lot of e-commerce companies, a lot of digital companies that have a need for digital marketing, hire a lot of email marketers. And these email marketers, especially where I'm at right now, are making significantly more than they did a year or two ago. So I think a lot of times what you can do is really outsource to stay lean when either a recession is happening, whether it's looming, just because a lot of times when there's a recession, the first thing to go is marketing, right? Obviously, you need operations, you need services, you're going to have your overhead costs, and you need a sales team or a customer service or support team. So it just makes sense to kind of outsource. A lot of times marketing is a luxury for growth. A lot of times it's difficult to justify just because you can't attribute every sale to one single touch point, but it's also not binary. There's a customer journey and there's multiple touch points that happen. So a lot of times, great marketing really addresses demand and it creates it, even when consumers are less likely to spend. So that doesn't necessarily mean you should be frugal about your marketing budget in particular during an economic downturn, but in terms of staffing and resourcing, you want to look for those sort of lean and agile solutions that allow you to keep the marketing machine on without paying an annual salary and without incurring those costs. I think the second thing you can really do is keep tabs on your overhead, right? When there's economic expansion, it's really tempting to make major hires and to build out a team. It's really, smart in some cases to invest in a building or buying a warehouse. But on the other hand, right, your overhead's still going to remain fixed. Whether your products are selling or not, whether consumers are spending, those costs don't really go away. So if you still have an expensive creative director or a CFO or this giant warehouse that you're leasing, and you still have to pay those bills month over month or year over year, you're just going to create bloat with your overhead. And, a lot of those companies are kind of the first to drown during a recession, right? So you want to decrease your overhead costs and create stronger margins for your business. I'd say the next thing is just make sure you have, within your marketing communications, just a really strong brand differentiator, right? Really laser focus on your unique selling points, right? Why are you different from your competitors, and why do your consumers need your product, right? It's not just about the product itself, but how you communicate it, because marketing is all about communicating, delivering value, and exchange relationships, right? A lot of the things that slow down when a recession hits are big companies, right? So when you communicate how your products are better than those household names, you can stand out, especially if you're a low-cost product or maybe an inferior good, so that way you can kind of take that market share back.
When times get tough, the inclination is to slash budgets, and marketing is usually one of the first to go.
That's Natalie Nathanson, president and founder of Magnitude Consulting, and she agrees that cutting marketing spending during a recession may not be the best advice.
This is a mistake, as you'd be cutting off the very programs that generate demand at a time when your business needs it most. Instead, spend smarter rather than not spending at all, focusing on the programs that generate the best ROI. Put your marketing dollars towards needs rather than wants. And finally, consider optimizing your headcount, which may include outsourcing some of your marketing function rather than hiring, and working with a marketing partner that can quickly adapt and pivot to changing needs.
So if you're not cutting marketing, which is often seen as a cost center, what can businesses do?
Prepare your mission-critical value propositions. Resist the Me Too type messages that cause you to blend in with the crowd. Don't forget that during an economic downturn, your customers and prospects are facing the same tight budgets and strapped headcounts as you. Focus your value propositions on something that not only makes you unique, but also helps your customer lay the foundation of success for years to come. The third piece of advice we give about marketing during economic decline is to diversify your customer base where possible. In other words, don't put all your eggs in one basket. Concentrating your marketing efforts on fewer verticals or segments to streamline your go-to-market efforts can be effective when the economy is strong, but during a slowdown, it further concentrates your risk. Instead, examine how your current customer segments are likely to perform as times get tough, and consider expansion into other segments to diversify your customer base, particularly as some verticals are more or less aligned to the overall economy than others. Also, ensure that you do not have too much revenue concentration in your largest clients. Ask yourself what would happen to your business if your largest customer left you unexpectedly, and start developing your fallback plan accordingly. Fourth, you want to be sure that you're placing a heavy focus on nurturing your existing customer relationships. Don't forget that they will likely be facing some of the same financial pressures as you. You want to ensure that your solution is a must-have when they're looking to make budget cuts, and also that you have relationships with as many internal stakeholders as possible. A fifth element to consider is right-sizing your offerings. There's a number of different ways to do this, including offering discounts to lock in clients for longer terms, or designing a lightweight version of your product or service with limited functionality at a lower price point. Our sixth and final recommendation is to build a recession-proof ecosystem. This means looking beyond your direct sales force and examining your partner and channel relationships. Look at whether and how these relationships will serve you during difficult economic times. You may want to consider adding alternate partnerships or diversifying your partnerships, whether that be geographic expansion, industry sector, or different types of partners altogether.
What happens if you do prepare for a recession? Maybe you listened to an analyst who forecasted a recession would happen 3 years ago, and then it didn't. Is it wasted effort?
Let's say a recession doesn't happen. I don't believe the effort is wasted.
Jeeyan Rostam-Abadi again.
You're still establishing a stronger brand and position. You're still increasing your customer lifetime value by using lifecycle marketing and content, and you're also collecting data that should translate to insights and learnings that are going to drive future growth for your business and improve your strategies across the board when it comes to your marketing and sales efforts.
So, what are the numbers here? What's the risk of not preparing? How much is really at stake?
To be honest, the best way to prepare for a recession is to have a long-term plan that's nicely diversified. Recessions can affect some markets more than others, so having different types of companies in different sectors and markets is key.
Roxana Maddahi again.
Also, it's really important to prepare yourself emotionally. As human beings, we can't help it. We act on emotions sometimes without seeing the bigger picture. The most dangerous investment behavior I've experienced is when clients call me on a bad day in the market asking to sell their holdings. Typically, in those cases, the market's rebounded just a few days later. Average investors make 3.8% a year in the stock market, while the S&P annualizes 11%. That's a huge discrepancy that all comes from human emotion over investing. The biggest risk when investing is not investing at all in fear of a recession. If your preparation involves being fearful and staying on the sidelines instead of investing, then yeah, it's a wasted effort. Being fearful is really dangerous for investors. When they adjust their investment behavior, usually by pulling out of the markets or switching to a very conservative portfolio in fear of an impending recession, they wind up missing out on bull markets and rebounds. Over time, even through recessions, markets tend to rebound really quickly and with more vigor than when they pulled back. The biggest risk is pulling out and not getting those rebounds. Look, being invested in 2008 was not pretty. The market was down 38%, and it seems like the end of our economy as we knew it. But if you stayed invested, even through the worst points of the recession, you very likely recovered all of your losses within 1 year. This past December is another example of how fears of recession can cause us to miss a rebound. The markets pulled back 9% in December of 2018 alone. Within just a few weeks, everyone was crying recession on the horizon. If investors pull out in fear of a recession, they would have lost out on a rebound of 23% since that low. Historically, bull markets outlast bear markets. Bull markets last an average of 47 months, and bear markets last an average of 13 months. Market rebounds also outlast declines. The stock market has experienced so many pullbacks throughout its history, but investors that stayed invested have been able to catch up when the markets rebound. At the end of the day, markets have recovered from the attack on Pearl Harbor within a year, the Cuban Missile Crisis within a month, and September 11th within a month. Markets recovered from the Brexit announcement within a month, and when the S&P downgraded U.S. debt, also within a month. No one knows when the next recession is coming, and to think is a fool's errand. The world keeps changing, there are unforeseen circumstances, and markets don't always act the way they're supposed to. A recession is part of a normal market cycle and should be treated in your portfolio as a period of time within a long-term strategy. Don't let the fear of a recession control you or guide your long-term investment strategy. I'll leave you with this last stat. A $10,000 investment in the U.S. economy in 1949 is worth over $17 million as of the end of last year, in the wake of 11 downturns that exceeded 10%.
Any discussion on recession and hedging investment risk today would be incomplete without at least touching on cryptocurrencies.
I want to discuss the 3 reasons why Bitcoin may just be the ultimate hedge against the coming recession.
That's Felix Hartmann again.
With Bitcoin, there are no negative interest rates, nor will there ever be, because you are your own bank. So when the time comes that interest rates are getting cut so low that we're being charged 1, 2, 3, 4% a year for owning our own money, people will look for an exit. And that exit is Bitcoin. The second reason why Bitcoin will be the ultimate hedge for this coming recession is inflation. The first monetary policy, of course, that we discussed, that the Federal Reserve and central banks love to use in order to keep a recession at bay, is interest rate cuts. But historically, those interest rate cuts are only about 5 to 6%. The problem is we are already at only 2.25% in the US, which means that such an interest rate cut would put us at deep negative numbers. Now, the chances are that the Federal Reserve will not want to impose such extreme negative interest rates. So the second option they have is printing money, quantitative easing, exactly what they did in the years following 2008. Now, the problem with quantitative easing is that as we print more money, your dollar loses value. Your purchasing power is crippled year after year. And this is why you might realize that maybe 10 years ago, maybe 20 years ago, a gallon of milk cost a lot less. Maybe a tank of gas costs a lot less. And all the other things you buy on a yearly basis. This is an extreme risk for anybody, especially the middle and lower classes who own most of their assets in cash in a bank. This cannot happen with Bitcoin because with Bitcoin, we know the exact supply of Bitcoins that are in circulation at any given point in time. There only will ever be 21 million Bitcoin, and we know exactly how many new ones are being released every single day, every single 10-minute period. This preset supply schedule ensures that there isn't inflation, but in fact, in a few years, there may actually be deflation as more coins are being lost than are being minted. This, of course, sets the stage for a very attractive store of value that will appreciate over time, just as gold has over the past few thousands of years. Now, the difference to gold is that with gold, we know that there are many, many more tons of gold in space and in the oceans and in the Earth's core than are currently in circulation. And advanced technology could lead the gold supply to become increasingly inflated, while with Bitcoin, with mathematical scarcity, we know the algorithm. Anybody can audit the algorithm, and anybody knows how the monetary policy of Bitcoin is changing over time. Now, the third and final reason why Bitcoin is that ultimate hedge is that capital levy has been used in several prior recessions where governments, having built up so much debt, grab into their citizens' bank accounts in order to pay off their debts. This has happened in many countries such as Cyprus, where people were losing as much as 10 to 50% of their savings because from one day to the next, the government grabbed into the bank accounts in order to pay off their debts. This is an issue because some families saved their whole lives for that money. Perhaps they were about to buy a house. Perhaps they were about to pay for their kids' college tuition, while others were squandering the money away. So it goes against our basic liberties that the government will unannounced garnish your money. The beauty is that Bitcoin cannot be victim of such capital levy because only you control the keys. Only you have access to your vault. When the next recession hits, just like in the past, people like to have perhaps 10% of their investments in gold as protection, as a hedge. It may be a smart idea to have 5 to 10% of your assets in Bitcoin as a protection. Let's assume the inverse event, that the economy keeps thriving and Bitcoin drops. You would lose no more than you invested. If you only invested 5 to 10%, that is what you would lose. However, in the event that the economy faces a significant collapse, such as we saw the Argentinian peso collapse in August, such as we saw the Turkish lira in 2018 lose 40% of its value in a single month, such as we saw the hyperinflation of both the currency in Zimbabwe and Venezuela. Currency collapses are becoming more common and common because of the practices by central banks and governments. So if you want to protect yourself, Bitcoin might just be that option. Because with Bitcoin, only you have access to your assets. With Bitcoin, nobody can charge you negative interest rates. And with Bitcoin, no central bank can start running the printing press in order to bail out the big companies on your dime. Bitcoin was created in the aftermath of the 2008 recession. Bitcoin was built for exactly this, and now is a time when it will be put to the test. Do your own research, but don't wait until the economy starts crumbling.
The takeaways. Based on historical trends, we are overdue for a recession. But financial experts have for years been calling for a downturn that doesn't come. Timing the market is a difficult game, but you can take steps to safeguard your personal wealth and your business to prepare for an eventual downturn. And odds are, taking some of these steps may be a good idea anyway. And when the recession does come, historically speaking, you're better off weathering the storm. I'd like to thank our contributors today, Roxana Maddahi of Steel Peak Wealth Management, Natalie Nathanson of Magnitude Consulting, Jeeyan Rostam-Abadi of Hawk Media, and Felix Hartmann of Hartmann Capital. Well, that's all we have time for today. If you're not a member of one of Forbes Councils and are interested in joining, go to the ForbesCouncils.com website to see if you qualify. Thanks for listening. Please be sure to subscribe, and we'll see you on the next episode.